Hi class, welcome to the final part of input tax. We're now looking at some special rules. First one being installment credit agreements. I would advise you to first maybe have a look at the diagram that I posted on Canva relating to installment credit agreements and suspensive sales. Just have a look at that and make sure that you understand the difference between the two. So an installment credit agreement encompasses suspensive sales and finance leases. Alright, so to rephrase, have a look at suspensive sales and finance leases and what the difference is. The definition of a suspensive sale and finance lease in section 1 can be summarized as follows. So although the definitions on that diagram that we had a look is summarized, and it's similar to a large extent, it seems that the major difference between a suspensive sale and a finance lease lies in the person carrying the risk of ownership of the goods supplied. So in terms of a suspensive sale, the risk of ownership will pass to the purchaser on the date that the suspensive sale condition is complied with. Where in terms of a finance lease, the risk of ownership will pass to the lessee at the date that the lease agreement is concluded. So in other words, finance lease, risk of ownership passes at the end, whereas with the suspensive sale, it passes once the condition is complied. Alright, so what is the value that we are going to have to use in order to calculate our input tax? So in the case of an installment credit agreement, the consideration in money for the supply is deemed to be its cash sale value. So the VAT based on the cash cost will be claimed in total as input tax at the earlier of delivery or payment date by the purchaser or the lessee, whilst the seller or lessor raises output tax in total on the cash cost of the goods at that time. The cash cost excludes interest, as interest is exempt from VAT. Remember, interest is exempt from VAT as it is seen as a financial service because it constitutes consideration for the supply of a financial service. Okay, very important. Time of supply is very important with installment credit agreements. In the case of an installment credit agreement, the time of supply is the earlier of the time of delivery of the goods or the time any payment is received. This rule does not apply when the supply is made under a credit agreement, in terms of which the buyer has a right to return the goods within a certain time. Therefore, for a suspensive sale agreement, the time of supply is when the cooling off period of 5 days has expired. So I can only recognize the suspensive sale agreement in terms of input tax after the cooling off period has expired. So let's have a look at an example here. So installment credit agreement, we're looking at a finance lease. So the bank enters into a finance lease on the 15th of May of the current tax year for the lease of a motor car to a clothing manufacturer as follows. So the cost of the car was 294,000, VAT calculated on that was 412, which gives us a total of 336,000. We add finance charges of 117,600, we get to a total amount of 453,600. So the agreement states that 36 monthly installments of 12,600 Rand, inclusive of VAT, are payable starting on the 30th of June of the current year. So the motor car was delivered on the 1st of June. The motor car is a motor car as defined for VAT purposes. Discuss the VAT implications of the above transactions if both parties have a 1 month tax period. Okay, so let's just break this down quickly. So the bank obviously has to account for output tax on the cash value. We said for installment credit agreements, specifically for a finance lease, we need to look at the cash value, and that cash value was 336,000, and we need to multiply that by the tax fraction. So the bank has to account for output tax of 41,262. The clothing manufacturer, on the other hand, is not able to claim any input tax deduction since the vehicle is a motor car as defined. So very important, can't claim input tax because it is a motor car. Should the clothing manufacturer purchase the car at the end of the lease, VAT is also payable on any consideration paid for the vehicle at that stage. Again, the manufacturer would not be able to claim any input tax deduction. Right, so let's see what happens when we've got a suspensive sale agreement. So assume the same information as the above example, except that it is now a delivery vehicle acquired in terms of a suspensive sale agreement, which provides for a deposit of 42,000 payable on the 15th of May of the current tax year. The monthly installments are 11,000 and finance charges totaling 102,900 will be paid over the 36-month period. We're required to discuss again the VAT implications of the above transaction. So the only difference is that the bank now has to account for output tax of 41,262 on the 15th of May. This is also the date on which the manufacturer can claim the input tax of the 41,262, assuming that the delivery vehicle will be used exclusively to make taxable supplies. Important here, this delivery vehicle does not satisfy the definition of a motor car. So in regard to a suspensive sale agreement, when a deposit is paid, it is immediately applied in reducing the total consideration due. That's very important. If I'm paying a deposit, I need to deduct that from the total consideration which is due. Okay, class, so this is now the final part of input tax, and we're looking at fixed property and the meaning of a supply. We're looking at the special rules. The term goods is defined in section 1 includes fixed property and real rights in fixed property, as you would have seen. So fixed property in turn also defined in section 1 and includes the following things: land and improvements to land, sectional title units, shares in a share block company, time sharing interest, and real rights in any of the above items. So since all of these forms of fixed property constitute goods as defined, a vendor who supplies or is deemed to supply fixed property in the course or furtherance of his enterprise is required to account for VAT unless the supply is zero rated or exempt from VAT. So what is the value that we need to calculate for fixed property? The rules pertaining to the general value of the supply will also apply to fixed property. However, there is no transfer duty. No transfer duty is payable in respect of the acquisition of any property under any transaction that is a taxable supply of goods for VAT purposes to the person selling the property. So all that basically means, remember what we said: if there is VAT on the transaction, there cannot be transfer duty. Converse to that, if there is if there is transfer duty on the transaction, there cannot be VAT. So if a supply of fixed property does not attract VAT at any rate, the supply will be subject to transfer duty. And I would like you to have a look at the transfer duty table. I think we have spoken about transfer duty and how it's applied on the sliding scale. So please have a look at that. The time of supply of fixed property. So when fixed property or any real right in fixed property is applied by a vendor, therefore excluding second-hand goods, the time of supply is the earlier of the following: the date of registration, which is usually the date that we are going to use, where registration or transfer is effected in a deed registry, or the date on which any payment is made in respect of the consideration for such supply. The time of supply, fixed property that is supplied in the course or furtherance of an enterprise. So for fixed property transactions in the course or furtherance of an enterprise between parties that are not connected persons, or where they are connected persons, but the supply was not deemed to take place at market value. The above time of supply rule does not necessarily correlate with the actual entitlement to claim an input tax or the liability to pay output tax. So in other words, the input tax may then only be claimed in proportion to the amount paid, irrespective of the date of transfer. The output tax is also only accounted for to the extent that payment is received. So I can only claim input tax in a situation like this in proportion to the amount that I have already paid, or considerations I've already paid for that property. Alright, fixed property not supplied in the course or furtherance of an enterprise. So fixed property that's not supplied in a circumstance like that could include fixed property that's supplied by a vendor, but where the fixed property, for example, related to exempt residential use. The fixed property, although supplied by a vendor, would therefore be regarded not to be supplied in the course or furtherance of an enterprise, as exempt supplies are specifically excluded from the definition of an enterprise. Remember, that residential use of a fixed property is exempt for VAT. Alright, fixed property not supplied in the course or furtherance of an enterprise would also include second-hand fixed property that's supplied by a non-vendor. In both these cases, the vendor buying the fixed property would be entitled to a deemed input tax on the second-hand fixed property purchased from a South African resident if such a vendor is going to use the fixed property in the course or furtherance of making taxable supplies. In this case, we however have to distinguish between vendors on the invoice basis and vendors on the payments basis. If that is the case, on the payments basis, when a vendor is registered on the payments basis, the deemed input tax is always claimed or claimable only to the extent that the payment has been made. If they are on the invoice basis, the deemed input tax for vendors registered on the invoice basis can only be claimed once the fixed property is registered in the name of the vendor. After registration in the name of the vendor, the deemed input tax can further only be claimed to the extent that the payment was made for the supply. Please have a look at the example. Good luck with the rest of your studies and with term test 2. I will see you all in the second semester. Bye.